All right, everyone. Time for the most interesting chart of the week. So, as always, at StatsEdge Trading, we are systematic traders, which essentially just means that we are going to trade what our system tells us to do. Now, what I spend a lot of time doing is building new systems, obviously testing, refining, that type of thing, but also just trying to figure out, okay, of everything that I'm looking at, what do I think the market conditions are going to be at? Because that may allow me to favor some systems over others. If we're in choppy markets, things like mean reversion, pullback trading work phenomenally. If we're just in markets that are just ripping all the time, and then maybe it's a little more trend following investment, that type of thing. So what I did a lot of last night to get ready for this is just prepping for, let's grab this, what happens after this. Right? This is pretty wild, pretty crazy that we just have 6 months here just straight up in a row here for the S&P 500. Let's just turn that dark mode. There we go. Just right up in a row. Just crazy, crazy environment where a lot of people would look at this and say, well, this has to be overdone. Up 6 months in a row, that's crazy. It's probably time to sell some stuff. But the beauty of this is, with the help of ChatGPT, I just built this little indicator, and this indicator just counts the number of up months in a row, and I just drew a line at 6. And then the reason I'm breaking down how I did the analysis is just to show you guys how simple this is to do, right? It's not, didn't do anything crazy, just said, okay, build me a little indicator on the bottom that counts up how many times you're up 6 months in a row. And then I just highlighted those. I said, okay, let's just go through history and let's see, is this normally a dramatic top to the market, or is this something that's pretty chill, right? It's pretty easy to do. And if you take, let's go back and look, and we notice that it's generally not going to crash from here, right? So this is the 2021. And I think if anyone was trading in 2021, you remember it. It was kind of like the environment we're in now, where you had these pockets of bubbles going on where, you had people buying pictures of monkeys for millions of dollars, a lot of crazy stuff that was happening. And the next month was down, but then we had another quarter, another 3 months of upward action before. This is when Russia invaded Ukraine and inflation and interest rates and all that. And we had the 2022, 2023 bear market. Now, this is another one where we're up 6 months in a row. It actually started like right on this candle right here. Then we had another 5-6 months up before we went into a consolidation. This was 2017-18. This was the first Trump administration. So a lot of things that were happening now are happening then as well, with trade wars and, fighting the Fed and all of that. So a lot of similarities were going on here, and another couple months. This particular one right here in 2013, man, imagine if you sold because you're up 6 months in a row and this thing just doubled, or 50% up in a straight line from here. Here's one in 2011, another 2-3 months up before a little pullback. This one here in 2007, right before the great financial collapse, but wasn't the sign of the great financial collapse. You had another little spike here before the financial collapse. Then last but not least that I could find, again, because the SPY only goes back so far, was 1995. And, that triggered right here, and the market doubled from there. So what does this tell us? Not a lot. Obviously not enough data there. Any trades that are part of the StatsEdge Pro systems, which again, you can get by going to StatsEdgeTrading.com, and you can sign up for the free email newsletters and the free courses here as well. Again, completely free, and they put you on the email list. So I'll just email you when a video comes out. All of these, in order to do a test, there's tens of thousands of occurrences, and you need that, at least I need that, in order to get confident with the numbers that are required in order to understand that that's enough probabilities that, okay, I'm good, I'm confident that I have enough occurrences in order to be happy with those statistics. So, what the 6 or 7 that I showed you there isn't enough, but it does show me that in none of those cases was it 6 months, 7 months up in a row, and then just complete fall apart. Even when they happened around bear markets that were occurring for other reasons, right? With great financial collapse wasn't up because this didn't happen because the SPY was up 7 months in a row. But even then, there was no occurrence of you go up 6 months and then you just crash. So that shows me that I shouldn't potentially be getting bearish in any sense because this is going on. If anything, what I might want to do is I might want to just sit back, continue to trade the systems, but maybe tighten things up, because in a couple occurrences in a month or so, we went to more mean reversion setups would work, where you saw a lot of chop or pullback in the market. So it's important to do this exercise, and I always want to share when I do these exercises with you guys, is just to say, hey, even if you don't necessarily gather too much data from it, it is a very important exercise to do. It's a very important exercise to look at. Try to find out what sandbox you're playing in, and then maybe weight certain algos for certain periods of time. Like the day trading, for example, isn't going to be as crazy when the VIX is so low and the market's so chill. So just, again, find the sandbox you're playing in, whether you're a discretionary trader or systematic trader. I hope giving you an insight into this kind of analysis and the work I do helps. If so, again, comment, share, all that kind of stuff. Until I talk to you guys next time, get away from the screen.